50-year mortgage. Does that sound like a good idea to you or not? And this is what President Trump proposed. One of his staff members came up with this idea, and I think it's a totally ludicrous idea. It just helps the banks, unfortunately. It doesn't really help people out, and I'll give you an example. So if we look at a $400,000 mortgage, and we look at it over 30 years, 30 years at 6 1/8, so 6.125%. Your monthly payment would be $2,430.44 a month. And if you did a 50-year, you would have a monthly payment. And again, I'm going to go up a little bit higher in rate because the longer the term, generally a little higher in rate. So I only bumped it up an eighth of a point to 6.25% for 50 years. And that monthly payment was $2,179.89, a savings of $250.55 per month. Not a lot for that much longer of a time period. It's not like going from a 180-month, a 15-year mortgage to a 30, where in the same scenario here, it was $3,348 a month for the 15-year mortgage. So you actually saved $900 and some odd dollars by going from the 15 to the 30, but going from the 30 to the 50, you only save $250. And $250 is a saving, right? That is definitely a savings that's going to pay for some groceries, at least a trip to Walmart or Costco of one trip, but not much more. And when you look at it over the lifetime, the amount that you will pay on that 30-year mortgage for that $400,000 is $882,913.20. So well more than double of what your mortgage was. This is where it gets really bad. When you go to the 50-year, and this is why the bankers win, it goes to $1,307,934.50 on a $400,000 mortgage paid over 50 years. This is why it's just a terrible idea. I'm a fan of the 30. I know there are some 40s out there, and I looked at those numbers. They really don't help anything either. Truly what helps is lower interest rates. And that is why we had a bump in September. September had the second most properties go under contract. It was the second most busy month here in 2025. It's simply because the rates drop. So you get rates into the lower sixes, that changes things. You get rates into the fives, that changes things. You get rates into the fours, so we're going to have a feeding frenzy in real estate again, and the market's going to ignite. Right now, because there's just not enough supply of housing, it's estimated anywhere from 3.85 million to 5.5 million houses short. So that's still a substantial amount. And when you look at what's being built is more expensive housing, not starter housing, not entry-level housing. Entry-level housing is what's being bought up by people like me. It's being bought up by mostly mom-and-pop investors out there looking at for rentals, which makes sense, and that's hurting first-time home buyers out there. And when you look at numbers, people ages 18 to 24, 57% of adults age 18 to 24 are living at home with their parents. Just staggering number. The next most staggering number, and this one's even more troublesome, the average age to purchase a home just reached 40 years old. That is insane. About 10 years ago, it was in the 20s. So this is just going up and up and up. And obviously, with everything that happened with the COVID lockdowns and pent-up demand, people moving all over the place, and super cheap money, talking about 2 to 3 to 4% mortgage rates, that has really stymied the market too. As far as people, it's locked in a lot of people. They call it the lock-in effect, where a lot of people are not moving, one, because they can't, because their current 2% mortgage, with what they have, if they sell that 2 or 3 or 4% mortgage and go to a 6% mortgage, their payment's going to be double what it was before. So there's no real incentive for them to move. If rates come down, that could change that quite a bit, could open things up, could really wildly increase inventory. But we're also noticing just a real consistent increase in foreclosure activity. I think this past month from Adam, ATTOM, which gives great data, I believe was up 19% year over year on foreclosures. So the numbers continue to go every single month. There's been at least 6 or 7 straight months here in 2025 where foreclosures are going up, which tells you jobs are not great. And we know that because the unemployment rate for people aged 20 to 24 is 9.2%. That's more than double what the actual unemployment rate is, which means there's not a whole lot of entry-level jobs, maybe from AI, maybe from companies pulling back because they're not sure about the future and where things are going, and they don't want to put too much money into people, training people, because they're entry-level where it's heavily training involved. So these are some of the things that we're running into. It's very interesting. The numbers, the average home right now, median home price is $440,387. It's up 1.4% year over year. So despite higher rates, which we've had the majority of 2025, the prices are still going up. And it does matter where you are, right? The Northeast has very limited inventory. Some of the Midwest has very limited inventory. And because of that, you actually have price still increasing at a pretty good amount. Then you have places like Florida where you have a lot of inventory, Texas where you have a lot of inventory, and a few others. Tennessee is growing. Other markets, Arizona, have grown as well. So we have those markets where you have more inventory. The prices may be stable or falling a little bit, but they're pretty stable. Even here in Florida, where I am, a lot of the markets have stabilized, and some markets that still have tremendous inventory are still dropping a little bit, but for the most part, they've kind of stabilized, and I'm expecting flat, maybe slightly down year over year. Could even be slightly up if rates continue to decline here before the year end. For a lot of interesting data out there. Now, people are still moving. The states that people are moving from, California, obviously, New York and Illinois. What do all three have in common? Well, they're very heavily taxed, for one, very heavily regulated as well. Where are people moving to? Well, number one, Florida. You had 22,000 people looking to move to Florida. Arizona came in second at 12,000 people looking to move to Arizona. And both these are retirement areas. So that makes total sense. A lot of baby boomers retiring. Some Gen Xers, older Gen Xers may be starting early retirement. And the other markets where people are going, you have Tennessee, North Carolina, Idaho. Idaho is exodus from California, South Carolina, and even Maine. And Maine for the beauty. I think a lot of people like the beauty of it up there. And they have quite a bit of an increase as well. So that's where people are going. Those are the markets where people are leaving and where people are heading to. So inventory is up year over year 6.7%, which is a decent amount, but not too much. We're still at half of normal inventory in this country. So it is still a seller's market in different markets. And like I said, it's very local. So there are markets where it's very much so a buyer's market, but things are pretty stable in most markets. Rents are falling, and that leads into, you had a record number of apartment complexes that were built in 2024. They all finished out. Now there's very few being built 2025 moving forward. So you're going to see those stabilize, those rents stabilize, and those rents are always usually less expensive than single-family housing is. And single-family housing is one that's very much in desire. But apartment rents are falling in key markets. And I've seen, actually just driving down the road, I saw first 2 months free. And they're trying to lock them in for, I think, multiple years in that contract. That's pretty much what's going on there. There is, obviously, the biggest effects we have here are the home shortage, which is really affecting first-time home buyers. We have builders that are just building more expensive houses. What can we do? What can be done to help rectify the whole first-time home buyers? Well, I think what will end up happening is going to be probably Donald Trump and his Scott Bessent. They've talked about this. They'll probably do a national home emergency, which will let them circumvent Congress so they can get around Congress and come up with some legislation to help. And I think the best thing to do, the smartest thing for them to do would be to have some kind of either no tax or a limited tax on properties under such and such an amount, say under 250 or under $350,000 houses that you're building. Kind of make it 350 just because it's hard to build a house for under 350 for sure with all the costs that go in there. But you can do maybe a very low tax rate for those people or even none, incentivize where they have no taxes for a period of time, or if you do a certain amount of properties, you get to a no tax point. So where you're providing enough housing. I think that's the best way to do it. You got to let the free market decide it, but you've got to incentivize them in a way. And maybe not make it zero tax, but make it much lower taxes for those first time home buyer houses. And you could even do that on the flip side, right? So if you want to incentivize those houses being available rather than single family rentals, maybe incentivize that those people sell those houses that are under 350. Instead of short-term or long-term capital gains, they're only going to pay a 5% tax, something simple, a basic flat tax that you really reduce things, that it puts more money in their pockets and at the same time gives more opportunity for first-time home buyers out there. I think that's probably likely what's the most likely scenario of what's going to happen. And it's something at this point that is really becoming necessary. I got my oldest son who's engaged to be married next fall. He can't afford to buy a house. They both can't, and their pricing is just way too much. The rates are still too high because they have student loan debt. They would have housing debt. Then they would have their car insurance, utilities, all these different things. And so many things have gone up. When you look at year over year of costs that have gone up exponentially, real estate taxes have. This was just an excuse with this market and real estate across country for all the states, counties, and local municipalities to jack up taxes on people, which is just a gigantic scam. And this is something that needs to come to an end. And DeSantis is trying to do it here in Florida. For at least your primary residence is getting rid of real estate taxes, or at least drastically reducing them, because you can't just continue hammering people on real estate taxes. And then insurance costs have gone up so dramatically in Florida, in Louisiana, and Texas, and California, and all over the country. I'm seeing everybody's at least doubled, if not tripled and more. You have car insurance going up. Insurance for everything is going up. Food, cost of good food is going up. Cost of utilities continues to climb. But at the same time, people's wages aren't going up that much. So now you're restricting the amount of money people have, and you're really hurting everything. You're going to see restaurants start to fold. A lot of small businesses go out of business, and this is exactly what we don't want. We're in the middle of November. When we get to December, we have another Federal Reserve meeting. They have to reduce rates. Only thing they could do is reduce rates. If they don't, we could be looking at a pretty hard recession going into 2026, but let's hope they do the right thing, because otherwise they're going to be playing rate catch up. That's all I got for now. Hopefully you guys got something out of this video. If you did, make sure you click the like button, subscribe to the channel, and I'll catch you in the next video.